Hello guys, today we're going to talk about infinite banking. How many of you guys have heard the term infinite banking before? It's all over the internet. You know, if you've been in our industry for any period of time, there's so many insurance agents and advisors and planners out there that are talking about this thing called infinite banking. And infinite banking is something that is actually, I believe, a very the concept in of itself is very good. I personally like it. It's just sometimes the way that it's being used is not, in my opinion, the correct way. A lot of times with infinite banking, what they do is they'll use a whole life product. And whole life is, let me just back up a little bit. The way that infinite banking works is you put money into a life insurance policy, and that money is in a cash value account earning a certain percent. And the way that insurance works, all cash value life insurance, is that any cash value inside of a life insurance policy, you're able to borrow the money out, and because you're borrowing it, you don't have to pay taxes on it. But the thing about it, the reason why it works so well is because you're not actually borrowing the money from your cash value account. The insurance company is lending you the money directly out of their general account. And so when they do that, they normally will charge you a percentage of interest on that loan. Let's say it's, it can range anywhere from 2%. I've seen it all the way up to 8%. And then they're going to be crediting you a certain interest rate on the money that's already in the policy. So you're borrowing money from the insurance company, they're charging you an interest rate. Your money over here is growing at a certain interest rate. And the concept of infinite banking is that you get a positive arbitrage rate. So if they're charging you 2%, you have to make more than 2% over here in your account in order for that to make sense. Now, usually what I see with whole life policies, and they're not all the same, and if you have one that's different than this, that's okay, but I'm just talking in generalities, is you'll typically see an interest rate being charged on a loan for whole life, usually around the 6 to the 8% interest rate amount, but you're only earning maybe 3 or 4% on your cash value growth. So what winds up happening is you're paying a net 4% potentially interest on a loan that you're borrowing your own money, where in that example it would make more sense just to take your own money out and use it as a withdrawal. So a lot of times, when people use infinite banking, if they use it with the wrong product, where you don't get the positive arbitrage on the loan that you're taking out, a lot of times, I normally wouldn't recommend that. Now, when you use Indexed Universal Life to do that, it's different. Now, what makes it different is most Indexed Universal Life products and companies, they give you a choice of how you want to take that loan out. So the first option is called a zero-cost loan option, where they'll, for example, credit you 4% in your account, and then they'll charge you 4%. So what that means is it's a net wash loan. So there's no actual cost to the client. And a lot of the companies will give you a contractual guarantee that if you decide to borrow money out, they're going to credit you exactly what they're going to charge you on the loan. Another option, which is called a variable loan, which is one of my favorite ideas, it's a very powerful concept where you can borrow money from the insurance company against your policy. They might charge you, say, 5%. But then if the index that is growing, your money is invested in a stock market index, let's say it does 8% that year, or 10%. Well, what's happened is you've borrowed money at 5% from an insurance company. Your money is still growing, say, at 10%. You've already used the money that they've lent you. Maybe you went out and bought real estate, or you did another investment. And so as you're using the money that they've already lent you, the insurance company, your money is still growing at a higher rate than the loan rate that you're paying. So for example, in that scenario, you might be getting a 5% positive arbitrage rate on money that you've already spent or you've already invested. So in that scenario, that's really the best way, in my opinion, to use the infinite banking concept. So I just wanted to give you guys that information and let you know, if you are looking into infinite banking, that you do consider those different loan variables that come into play.